All right, welcome back, everybody. Today is an interesting topic and one that's near and dear to my heart. So I'm calling today's episode Everything I Wish I Would Have Known When I Started Healthcare Practice. Just to give you a little bit of a background on me, I started my career as a healthcare professional. I was a physical therapist, which was great. But when I came out of school and I started working, I didn't have much of a grounds in terms of what financial planning I needed to do, what it meant, what was important, what was not important. So, what I hope to do with today's presentation is just go through some things I wish I would have had. And even looking at YouTube and doing a cursory search, I really don't like what I see out there. There's not a lot of information still. So I wanted to provide this educational resource and presentation. I really hope it's helpful to you. If it is, please comment below. If you'd like to see more content like this, please let me know. I'd love to engage in that way and share what I know. So I'm actually going to share my screen and present a presentation slide deck for you. And basically, this is a presentation I've given to a few healthcare programs, but I thought it would be helpful to actually put on YouTube. So I'm going to just pick out highlights from this and hopefully pull out the most relevant information from this. So first, since this is a presentation, it's basically about the entirety of financial planning, and I'm gearing this presentation to physical therapists. So this is what you need to know and hopefully nothing of what you don't need to know. So just as a disclosure, everything on this channel, as always, is for educational and informational purposes only. This cannot be construed to be personal financial advice, whether that be tax, investment, or legal advice. And so after seeing this video, if you want to engage with us, I am an investment advisor representative at Brightworks Financial Planning, and that's something that you are free to do. I hope you do it. If not, this is meant to be strictly educational. And if this answers all your questions, then great. I have succeeded in educating you in an area that I think is vitally important. So without further ado, I just want to go through what financial planning actually is. So the purpose of this video is to have you be familiar with what is it when we say financial planning. It means a lot of different things to a lot of different people. So we're going to go through this pyramid, and at the bottom of financial planning is what people commonly they call it budgeting. It means cash flow management. Um, and we're going to go into detail of every single part of this pyramid, but these are arranged in the right way such that you need to have one in place before you move on to the next one. So let's just go through here and understand that this is a systematic process. It's meant to be goal oriented. It's not something where you give someone information and they take it and then they have a plan. It's meant to be a back and forth dialogue between you and a financial planner. It's holistic. It takes into account what your values are, what's important to you, what matters, what doesn't, how do you view money, and not only the educational aspects, but also the behavioral aspects. And a good financial plan is meant to be reassessed. It's not a one-off. And so putting these together is really a lifetime pursuit. So we're going to start off with cash flow management. This was a presentation for a different audience, so I'm just going to kind of pick out what I think is most important. When we say cash flow management and budgeting, what we really mean is how do we align your behavior with your goals, whether it be past decisions you made, present decisions you're making, or future goals that you have. And so basically what this shows is you may have seen that there's something called an urgent and important matrix. And basically what that means is not everything is urgent and important. Some things are urgent, but not important. Not everything is urgent. Some things are not urgent and important. And some things are non-urgent and not important. I changed the word not important in here to routine. So when it comes to money, we spend it in a couple different ways. And for example, if you own a home or if you have something that is of value and it breaks, so your car breaks down or a pipe busts in your house, that financially is going to cause both an urgent and an important expenditure. And so that's the top left column. That's the top left quadrant. And basically, that's the reason you have an emergency fund, is because there will be things that are both urgent and important. On the bottom left quadrant, I'm calling this the urgent but routine. So meaning if you do not pay your mortgage, you may lose your house. That's urgent, but it's very routine. It's the same amount of money you spend every single month. On the top right, we have not urgent, but important. And that's where investments and a lot of goal planning goes. This is the one, and that's why it's highlighted in green, that a lot of people skip. And I would argue it's one of the most important ones here. And then we have non-urgent and routine, meaning discretionary spending. And the other word for that is distraction. So those are things that keep you from putting money in that top right corner. So what I want to explain to you is that cash flow management is very important, not just from a dollars and cents perspective, but from a behavioral aspect. So I would really want you to understand, why do you spend what you spend and how do you prioritize? So the biggest takeaway from this slide in terms of how do you start out? How do you build the foundation for budgeting and cash flow management when you have your first job, or you're early in your career, or you just want to get back on track and you've not done this well for years? First would be, you need to have 3 to 6 months of living expenses in the event that a crisis occurs. You want that to be closer to 6 months if you're a sole earner and you have dependents. If you're in a two working family, or a two working, where your spouse works situation, or significant other, 3 is easier to get away with, but I want you to really take that away from cash flow management. I'm going to skip this slide. So basically, the important way for you to get a hold of this is to actually track it. So the way that you would track this is you need to create categories, and the 3 categories are static, control, and dynamic. And basically what that means is, static money is 30-day spending money that you know in advance. Literally on the first of the month, you know exactly what you're going to spend in these categories. That's where mortgage would go. That's where car insurance goes, life insurance, things like this that you've already committed to do. This gives you an idea of your past behaviors. Control is more of a rolling 7-day account. Sometimes we could call this variable or discretionary expense. This is something where you would make decisions weekly about how you're actually spending your money. And this is your current thought processing. And then dynamic would be money that you set aside for goals, investing, and retirement and savings. This is not time-based. This is just how much money, and you could choose whatever time period, whether it's monthly, quarterly, or yearly, are you putting towards future goals? This could be a vacation. This could be education for children. This could be retirement spending. But these are things that we call dynamic because they are going to they're going to change over time, but they need to be consistently saved for. So one idea here is track these 3 categories. Figure out, what is my static, what is my control, and what does my dynamic bucket look like? And basically, this is a starting point for you to meet with someone like a financial planner, if you feel like you're having trouble with this, to kind of get under the hood and figure out, why are these categories the way that they are? Because really the goal here is to put a large amount of money, and I'm not going to say a percentage because it's really hard to know, but basically you want to move your money closer to the dynamic side and not be spending so much in static and control areas that you have nothing left for dynamic, which is where a lot of people find themselves. And so remember that financial planning is behavioral. So one really good tip here is, create these 3 buckets. These might be 3 different accounts. They might be 3 credit cards if you are disciplined enough to pay them off at the end of the month. And so what you can do is you can actually set up these 3 different accounts and put the money in them so that you can easily track. It doesn't require a ton of receipt keeping or anything like that. What you need to do is just set up the account so that everything that account represents a static expenditure. Everything in this account is control expenditures. Everything in this account is dynamic expenditures, meaning savings. And you can easily see, where am I at and where do I want to be? So I highly recommend this system. It's very straightforward. It's very simple, and it doesn't require a bunch of apps or saving every single receipt, but it also gives you a great insight into your behavior. So getting the behaviors right is the one thing I wish that someone would have educated me more on earlier, is because habits are formed and they're hard to break. And so this is a way to get you in the right habits to see how you're making decisions. You want to disincentivize and make things hard that you don't want to do, and you want to automate things that you do want to do. So you want to automate your dynamic and your savings goals, and you want to make it as hard as possible to overspend in these control areas. And that's just a good behavioral tip to meet these goals that you have for the future. I'm not going to get into necessarily cash flow tips, but basically there's a couple of rules of thumb. If your rent and or mortgage is more than 25% of your gross monthly pay, you may want to take a look at um, other options available to you, whether it be refinancing. I'm recording this as of February 2024. Rates right now are not in a place where you'd want to do that. But basically, you want to not shackle yourself with monthly expenditures that are over and above what your income level support. So again, that's similar ideas on car purchases. The goal here is not to give you a step-by-step, and you can pause the video and read this slide, but I want to just give you general ideas and rules of thumb. If you are young and you have healthcare, you may want to think, do I have a high deductible plan? Those are usually cheaper. And so if you can save that way, if you can shop for home and auto, that will be a great way to save on monthly cash flow. And then basically having someone look over your work benefit package is helpful because oftentimes you get yourself signed up for things that you may or may not need. So those are my tips on cash flow. Let's talk about risk management. Basically, this is plan for the unexpected. Life's going to happen. What happens if you're not here? What happens if you get disabled and can't work? What happens when you're older and you want to provide care for yourself? These are things that are in that risk management part of the pyramid. And this is a very important area. And so cash flow management and risk management together form the base of that pyramid. And this is, I want to reiterate, 3 to 6 months of emergency expenses is a great risk management tool. This slide is about life insurance. Again, the goal of this is not for me to go exhaustively through every single slide, but I do want to say there's two types of insurance, term and permanent. Term is very cheap, and usually it's in coverage periods of up to 30 years, not usually beyond that. And really the goal of that is to ensure that you have income and ensure that that income is replaced over a time period if you were to be gone. And oftentimes people put in expenses if they have children for education. Permanent insurance is more of a it's more of a hybrid vehicle where you're going to gain actual value in the account when you're alive that can be usable. It's much more expensive. And so if you're listening to this presentation and you just graduated or you started your first job, or maybe you're a couple years in, highly recommend that you have a term policy. How much is dependent? You're going to see ranges. It's usually a multiple of your salary. If you have dependents, I personally recommend that you would get at least 10 times your annual salary in term insurance. If you are young and healthy, that usually will not break your budget and can be relatively inexpensive. Disability insurance, this is important. So understanding the difference between short-term and long-term disability. One thing that you need to be aware in terms of this is long-term disability typically kicks in anywhere from 3 to 6 months. Could be when the disability actually pays out. You're going to choose that when you sign up for a plan. And these are commonly offered through your employer. Almost always, one of these two is going to be offered, whether it's at no cost or low cost to you. In the event you do not have this, highly recommend that if you're an early career professional, you consider getting at least a 60% coverage rate of long-term disability. And one thing you need to understand is if this is paid for by your employer, if you were to get disabled, those payouts would actually be taxable to you at your ordinary income rates. If you bought this as a third party from a third party and you paid for it, then the payouts would be tax-free. So disability insurance, very important, long-term, especially because you're much more likely to be disabled during your working life than you are to die. And by far, as a financial planner and someone who sees people regularly, this is a common type of insurance that people do not think about, even though it's more likely. So please consider this, take advantage of the workplace benefit if it's available to you, and consider a supplemental policy if you don't have access. All right, investment management. Let's talk about this, and retirement planning. So I'm going to tackle these together. The reason I'm tackling these together is because when you're early on, these are going to really go together. So you're probably going to be doing your investing in one of maybe a few types of retirement accounts that are available. If you're an early healthcare professional, and if you're watching this, if you're a physical therapist or uh, some other job that's in the healthcare realm, you probably are going to have a 401k. If you work for a nonprofit hospital, that's going to be called a 403b. But basically, this is a low-cost way for you to invest on a pre-tax basis to start for retirement. So what would I tell you? I would encourage you as early as possible, save at least 10%. I would love for you to get to 20%. But I understand there are student loans and other things to consider. So what I would say is utilize inside your 401k. There's going to be often what's called target funds. So if you graduated recently and you're watching this, that means you probably want to have a target fund that's at least 30 years away, maybe 40 or more, depending on what your age is. So for example, if you graduate and you're in your mid 20s, you may think about going to the target retirement fund that's somewhere around 2065. And the reason you choose that is you want to sync it for the year that you think you might retire. The reason that's important is because if you just know absolutely nothing about investing and you don't have anybody you feel like you can talk to about it, or I would highly encourage you to reach out to someone like myself. But in the event that you don't, the those are made to put you in more and more equity positions, and or that would be like mutual funds, that sort of things that are stock based um, funds. Those would be highly concentrated in your early years. And then as you get older, you would have more and more conservative or what's called fixed income inside that. Sometimes people refer to that as bonds. And so at the beginning of your career, you'd have almost all investments in equities or stock-based mutual funds. And then at the end, you would have a much more higher allocation of bonds. So it just makes sure that your risk gets less over time. But consult a professional when you're thinking about making that decision. I wanted to provide you guys with an actual example of what this looks like, because a lot of these presentations I find don't actually break it down for you. So what I want you to see in the box here is there's really three categories. One says since inception. Basically what that means is what has been the return on a percentage basis of this fund since it started. The inception date, I'm just going to use the first example, is June of 2011. And then what I want you to look at as well is what's called the net expense ratio. This basically means what on a yearly basis does this fund charge by way of expenses? So this is saying 10 basis points, or another way to say this is 10% of 1%. So these are very low, and these are all target retirement funds. This is not meant to be an advertisement for Vanguard. I have no recommendation here. I just want you to understand how things look. So again, I mentioned 2065 before, so you can see 2065 has had a since inception return of 7.96%, which is great. It also has a lower net expense ratio. So one thing you'll see is that as you go higher, you should see a since inception rate that tends to go up over time in general. The reason that these 2065 hasn't reached the level of 2060 yet is it just hasn't had enough time. So likely this will jump up, in future years, closer to those 9% values. But hopefully that kind of demystifies it a little bit about what these actually mean. You want to look at all three of those things, and making sure that just because it's to the right of the 10-year value does not mean it's greater than 10 years. So I want to make that point clear as well. So sometimes people will look at the 10-year percentage rate and think, well, since inception must be longer than 10 years. Well, it depends on the fund. And that's not the case in 2017, and that's why there is no 10-year percentage there. All right, here's a slide that talks about the different types of retirement accounts. So these are vehicles that are set aside strictly to save for retirement. I want to draw your attention to a few of these. One, I want to start with the Roth IRA. So basically, this is an account that you can put money into, and it actually grows completely tax-free. And when you take it out, it is tax-free to you when you take it out. There are some disclaimers here. So meaning, in order for you not to have any taxable implications, the funds need to have been in the account for 5 years, and you need to be 59 and a half or older. You are able to take money out that you put in, but you would be taxed on the growth if you were to take it out before 59 and a half. The Roth IRA is really powerful, and here's why. When you're young, you probably are not making as much money as you will later. And there are actually income limits on saving and utilizing a Roth IRA. And so my advice would be, if you're early in your career, if you have a choice, I would try and save as much Roth money as you can. Now, I want to be clear here. Roth IRA is called an individual retirement account, but many of you might go to your open enrollment period or just when you start a new job, and you will see within your 401k, there is actually an option for you to elect Roth contributions. Basically, what that means is the money that you put in will not be deductible to you in the year that you put it in. So it's going to go in after tax. So you lose that upfront benefit, but what you do get is when you take it out eventually, there's no tax on that at all. So the reason I say that is inside of a 401k, you can put up to, as of 2024, $23,000 a year as a Roth election. Outside of a 401k, if you're using just a Roth IRA, you can only put $7,000. So there are benefits to each. I can't go into specific details in terms of why you would use one in a nuanced way, but I would say in general, if you're young and you're not a high earner yet, I would highly advise you to take advantage of a Roth IRA or utilize Roth 401k contributions. So outside of that, I would say, remember that 401ks often have matching contributions from your employer. So please consider taking advantage of that. So it may be something like we match 100% up to 3%. So when you go to sign up, I would highly encourage you, no matter what, to put at least 3% in that account. The other accounts are important, but I don't want to emphasize them in this presentation. I think understanding that Roth is where you should probably put your money, assuming that you are not married and your spouse earns a high amount so that you would be considered in a higher tax bracket. That's when these other accounts would become more important. And that would be the first account above, which is an IRA or a non-qualified account. But if you find yourself in a higher tax bracket, excuse me, I would still encourage you to take advantage of the 401k because those contributions are deductible on your taxes, depending on your income levels. Again, there's a caveat there. Okay, let's talk about tax planning. Basically, this is how do you reduce your taxable income? How do you maximize the deductions and things that might be available to you? This is unique to every person. I just want you to understand this category exists. It's a major reason why people reach out to financial planners. So I wanted to just discuss this so you have a category for what it actually means. Again, if you own a business, you and or your spouse owns a business. Say if you're a healthcare provider and you want to start your own practice, then tax planning becomes a lot more important. Do you own real estate? Do you anticipate having an inheritance either from a family or from another business interest? These are all things that would make tax planning a lot more important. And then again, what is your marginal or effective tax rate? If you are in a much higher tax bracket, you are going to need to pay a lot more close attention to this area. Estate planning. If you're young and you're watching this, you're probably not going to be too interested in this, but I will say pay attention because there's a few things you should still have. Everyone should create a will. And basically that just is a document, a legal document that explains what do you have that goes where in what manner. So this is especially important if you have dependents. So I would say as a financial planner, I do not draft estate documents, but I advise people on what might be the most prudent thing for them to actually put in place and then refer them to an estate attorney that can actually draw up the documents. So this becomes much more important as you have dependents. So if you're married, you have children, you really need a will and at a minimum, and you need a guardian document to determine what would happen to your children in the event that you were gone. So I'm not going to spend too much time here, but there are other reasons you can do estate planning. There's a lot of reasons actually, but I can't focus on that in this presentation. All right, so if you just graduated, you're a new professional, or you're a student watching this going, I'm so glad I found this because this is all the questions I had. Here are the things that I think are relevant, and this is geared towards physical therapy students, so I'm going to put it in that perspective, but I think it could be relevant for anyone who's graduating or starting their career. Here's some things you need to know about student loans. Grace period is 6 months after graduation. You have until the first payment is due on your loan. These categories you need to understand. What does subsidized mean? What does subsidized mean? You'll see these on your account statements of your loans. Basically, subsidized means the loan does not accrue interest while in school, at least as long as you're at least half-time or you're in deferment. Unsubsidized means interest on this loan continues to accumulate even while you're at school, and it will capitalize, and dropping down to the bottom. Basically, this refers to an increase in principal for accrued interest. So if you just started and your grace period is over, you may see that your principal jumps up a bunch. It's because all of that interest on those some subsidized loans just got added to your principal. Forbearance. Basically, this is an area when interest does accrue, and usually there is a lower bar to actually be in forbearance than there is in deferment. So in deferment, you have to have economic hardship, unemployed, and it's only available for federal loans. This is a busy slide, but what I want you to get out of this is I'm going to draw your attention to the bottom of this slide. And this actually references a program called the SAVE Plan. And basically what the SAVE Plan is it just got passed in 2023. It's a new income-driven repayment plan, which everything on the screen that you see is income-driven. So basically, you're going to pay on your loan a percentage of what your income actually is. So what I want you to see here is the SAVE plan is formerly called the revised pay as you earn plan. And basically what this means is you have to have an income level that will qualify you for this plan. And basically what it does is it takes a percentage of that income based on if you have undergraduate or graduate loans, and you are capped at that's how much you actually pay per year. So the amount of your loan is actually irrelevant here. So I want to be very clear about that. So basically, you have a percentage of what's called your discretionary income, which is not the same as your adjusted gross income. So on this slide, you're going to see a term, or not a term, a abbreviation called AGI. That stands for adjusted gross income. So what I want you to know here is that is usually, basically, you can think of that as what do I actually make? What does my employer say my salary is? So you're going to take that adjusted gross income number, and then you're going to subtract it by 225% of the Department of Health and Human Services poverty guidelines for your household size. So I'm just going to do an example, okay? And then just follow along with me, okay? And this isn't on the screen, but I want you to listen. So if you make $70,000, that's your adjusted gross income, and you're a single person, the poverty guidelines for single for 2024 are somewhere around 15,000. You can actually go look that up yourself, but I'm just going to use 15,000. So we're going to take 15,000 and we're actually going to multiply it times 2.25. That number is actually 33,750. Okay, so remember that number. We're going to take 70,000 and we're going to subtract 33,750. That leaves us with $36,250. Okay, so what does that mean? That is your discretionary income for the year. And so basically what they did is they took what you make and they took out a large portion of it so that you are paying your loan as if you made this number. So if you're at 36,250 and you have all graduate loans under the SAVE plan, you would be capped at paying 10% of that over the course of the year. That number is 3,625. If you take that on a monthly basis, that is $302, a very manageable payment for someone who makes $70,000. Now, I want you to know some certain caveats. This implies that you will pay off this loan for 25 years. So be aware, if your income never changed, because you're going to recertify every year to determine, do I still pay $302,000? Because your income level might fluctuate. If you pay $302 over 25 years, you are going to pay a total of $90,000 and 625. Okay, that's basically what you would pay. So I basically just took 300 on a yearly basis. That's roughly 3,600, and then we're going to times that by 25 years. So you're paying just shy over $90,000. Now realize your loan might be a lot less than that. And I know it most likely will be. So for most people that have a loan balance that is large, this is going to disproportionately be a positive thing. Now, if your loan is much smaller, that wouldn't make much sense at all. So if I have a $30,000 loan, and even though I make a lot of money, I would still pay $90,000 over 25 years. Be aware, this plan, you can still choose this plan and it would not be best for you. So it may be helpful to use either an online calculator. There's a lot of good websites out there. Student Loan Planner is a great one. There's some places where you can put in your calculator to figure out which one is right for you. So I just want you to have an understanding of that. And then you can take what I just did and you can apply it to these other programs to understand what your payments might be there. So if you need to pause the video and do that, that would be a great thing. All right, how do you choose which plan to go off of? This is a tough question. And honestly, part of it starts with what kind of person are you? Do you want to pay off debt as soon as possible? Are you okay with paying debt over 25 years? You have to answer that question first in order to go through the decision tree to determine, is this the right thing for me? I'll just tell you a little bit of my personal story here. I paid my loans off in just under 5 years from PT school. My loans were about upwards of 80,000, I believe, 85,000, something like that. I personally did not want to have a loan for a long time. That was my decision. And there's no right or wrong there, but I chose to put a plan in place to get my loans paid off faster. And so that's the first question you have to ask. And the second thing would be, what is your status? Are you married? How do you file taxes? Are you separate? Are you joint? What is each spouse's relative loan balance? These are all questions I can't answer in this presentation. They're a great way to reach out if that's something that you're trying to make a decision on. These are things that a financial planner could really help you with. And so there's really no right or wrong here, but just know these plans are not one size fits all. This is the information about the SAVE plan. I'm just gonna allow you to look over this for yourself. I'm not gonna go over every single one, but I already told you the biggest benefit of this plan. But I'll point out two of them. One is a larger portion of your income is excluded in the calculation of how much you actually have to pay on your student loan. That's where the 225 or the poverty guidelines comes in. The second is this actually will not allow your interest to accrue if you're paying what you're supposed to on the save plan. So let me make that really clear. If the save plan says your payment is $80 a month and your loan accrues $100 of interest a month, normally, even though you pay 80, that interest would be higher than what you pay. So your loan would get bigger over time. This actually caps that so that that interest does not cause your loan to go up. In this case, it won't go down, but it won't go up. So that's actually a great benefit. And if you happen to have a low balance, you can receive forgiveness in as little as 10 years under this program. There's a couple things that haven't fully rolled out here, but they will by the summer of 2024. So this is a great option for those that are seeking an income-driven repayment plan. All right. So one thing you need to know as well is in order to benefit from some of these student loan income-driven repayment plans is you need to have a consolidated loan. So what I did was I took the case of a graduate here. They graduated last year, end of last year. What are they going to do? They're looking for a job. Basically, they have $75,000 in loans. Some are subsidized, some unsubsidized. Step one should be this borrower should consolidate their loan. And that means calling your servicer and telling them that you want to get a federal direct loan. This will allow you to get into the income-driven payment plans, including the SAVE plan. Basically, what is your situation? This particular person has a salary that matches the loan balance. They have no undergraduate loans, and they're single. Assessing your goals. This student and this new professional has a goal to actually live a balanced life. So meaning they don't want their day-to-day expenditures to be so impacted by a really, really high loan payoff that they want to be in an income-driven repayment plan. This is also a good time to get with a financial professional to kind of get your overall financial plan in place instead of just student loans. But this would be a great starting point. So here's kind of what the job offer looks like for this individual. The employer offered them 60% long-term disability. The 401k match is 100% up to 4%, and they have group life insurance at one time their salary. They're currently renting. They have a 5-year plan to buy a house. They don't have consumer debt or credit cards. They only have $1,000 in savings, and their monthly expenses are $3,000. All right, let's go back to the pyramid. Where do we place this person? What have they done well? What do they need to do? Well, I can tell you right now, if they have $1,000 in savings, they probably need more than that because remember, 3 to 6 months expenses, they're going to need at least $9,000 in savings. So that would be a great goal, number one. The next thing would be consider what their cash flow looks like. $3,000 a monthly expenses is not bad. It's actually very low. But if there's a few areas that they could work in, some budget moves, make some budget moves that would greatly impact them. What does the payment look like for 3 different repayment plans for this individual? So this shows what on a $75,000 salary. Remember the example I did earlier was 70. So again, this is income based. So under the SAVE plan, if he were to make 75,000, he would pay 351 a month. Realize that he's going to pay $105,000 over the life of that plan. What are the recommendations for this person? So the SAVE plan gives them the lowest monthly amount. They should start building that pyramid of financial health, starting with their emergency savings. The employer match at their 401k they should start at 4%. And basically, how do we up that percentage for retirement so we can plan for later? And I would say within that 401k, they should elect Roth. All right, here's one thing that people consider. What is the benefit of paying off a loan versus investing in the stock market? And that really depends on what is your loan rate. So if your loan rate is very high, and I would consider that somewhere, in the 6 to 9% range, depending on what interest rates are at the time. So right now, you can earn 5% in a high yield savings account. So 6% doesn't seem very high. But basically, in the event that there's not much that can be earned at those at lower percentages, you may want to think about aggressively paying down the loan. Now, I will say this before you take the leap. As a financial planner, I love to see people get out of debt, but I want you to understand there's a sacrifice involved. If you want to pay your loans off, you have to make sure you're ready to sacrifice. So basically, here are some rules, and a couple of these don't require that extreme sacrifice, but I would say it's well worth it. Number one, you have a small loan balance. You think you can pay it off in 3 years. That's a no-brainer. I would not choose an income-based plan. Number two, you have a working spouse that has a high enough income that you could even live off their income. I would say do not do an income-based plan. Just pay it off. If you have a lump sum, maybe your parents had a custodial account for you or something else that you can really chunk at these loans, I would say pay them off. You have the ability to do so. Number four is basically the situation where you're going to just grin and bear it, and I'm going to pay this loan off, even though it's an astronomical amount. In the case you do that, you're just going to have to get really, really disciplined. Live well below your means. It's the only way to do it. There are no shortcuts. If you have a sizable assistance program at your job, you may want to factor that in. So meaning it might be more beneficial to just take that free money and utilize either an income-based plan and invest the rest. Again, timing is important. And if you don't hear anything else in this area, you cannot wait 10 years to invest for retirement. So what I want you to see here is on the screen here, I have a quote from Einstein. It says, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Very true, especially when it comes to investing for your retirement. So think about this. So say that student one or new professional one comes out of school. They start investing early. Like they actually do it. So they invest $6,000 a year, and they at the end of a 30-year period, that at a 75% return rate, they have 620,396. So basically, they were able to compound that interest over a large period of time. And the reason I want to show you that is because 6,000 a year, if you just take that, only 180,000 of those dollars were money that you put in the account. So that means the rest of that, up to 620, was actually just a result of the money working for you. So another way to say that is only 29% of that total amount was actually the money that you put in. So if you are going to wait 10 years, so let's say we take the same amount, okay? We're going to put 6,000 in a year. We're going to grow at 7.5%. And this time we only have 20 years to grow. Guess what the number is? That number is less than half. It's $259,828. Okay. So your total amount is only 259, and just keep that in play because you still put in 6,000 a year, but you only did it for 20 years. So that means your total amount, that means 46% of that is what you put in. That's the value of compound interest. Time is your biggest ally. Do not miss out. Okay, so if you don't hear anything, you have to invest day one when you start working. Or if you're hearing this and you're 1 year in, 2 years in, it's not too late. Just do it now. All right, this is about a job offer. Again, you can pause it and look at the numbers here. It's actually not that important. But what I want you to see here is that job one is the middle ground. It's a $75,000 salary offer. Job three is the low ball. That's $65,000 for a new job for a physical therapist. These are actually pretty relatively accurate numbers. Job two seems like the far and away winner. But what I want you to see is that when it comes to financial planning, you want to automate as much as possible. You want to incentivize and make as easy as possible the things that are going to make you the most money. And you want to make it as hard as possible to spend money on the things you know you shouldn't. So when it comes to investing for your future, you want to automate that and make it forced savings. So take a look at this. So basically, I want to draw your attention to job three. It has the lowest salary, okay, but it has the highest match. So the 401k matches up to 5% compared to the others. The other thing that's unique about this is basically your employer throws in $1,800 per year for student loans. That is massive. You didn't have to do anything. They're going to pay on your loan. The other thing is those two things over time will allow you to save and you didn't have to do anything. So what I'm trying to say here is know yourself. Just because you have a shiny high offer in terms of your salary, look at the total compensation and look at what you have to do versus what's done for you. So job two has the highest salary, but there's no student loan assistance and there's no match at all. So in order for you to make up for that, you're going to have to take money that you've already been paid and you're going to have to choose to invest it in order to get to that 498,000 at the bottom. And I'm just trying to say, if I was a betting man, I don't think you're going to do that. So behavior is paramount. Knowing what your behavioral constraints are and how to automate is super important when it comes to your future. All right, I want to go into this section. This is super important. How do you actually choose a financial planner? Basically, there's a couple ways to know if someone is acting in your best interest. One would be they have the CFP designation. At Brightworks Financial Planning, it's myself and David Poole. David Poole has the CFP designation. I don't have that yet, but I am an investment advisor representative, which basically means I'm held to the same fiduciary standard. So you want to make sure that whoever you're working with is a fiduciary. So if they're an IAR, it means they've passed certain exams to make sure that they are working in your best interest. So I work in the best interest of my clients. David works in the best interest of his clients. You want to be very careful about who you choose to work with. I personally would be very wary of people that are just representing one insurance company. Because if they're a captive agent, they're really going to only offer you solutions that are under their umbrella. You want someone who can represent the entire market. So Brightworks Financial is an independent fiduciary investment advisory firm. And so we're not captive to one investment company or insurance company or anything like that. All right, here are the great questions to ask. Are you fiduciary? How do you get paid? They should be able to answer those really, really quickly. Are you an agent of a broker dealer, an agent of insurance company? Or are you an investment advisor representative? Super technical question. Most people are not going to expect you to ask that, and it will probably make them sweat a little bit. You want them to be an investment advisor representative. Okay, that's the fiduciary answer on number three. How do you get paid? You don't want to hear, I get paid basically off commissions, whether that be on the investment side or insurance side. You want to have someone that gets paid either on a discretionary basis of what assets they manage or a flat fee. Those are great fee models. Those are the ones that we use. David and I at Brightworks both have licenses to sell insurance. We offer that as just a customary service if that's something you want, but we use a third-party broker that can give you whatever company you'd like. And so you can either take that quote and go to whoever you want, or we can place it for you. In that event, we would earn a commission, but there is no other commissions that we would earn outside of that in our practice period. Do you offer proprietary products and investments? So basically, you don't want someone who's just going to put them in funds of their broker dealer or their bank company. You want to know if they're older, what's their plan? I mean, a lot of people are working with advisors as an industry, we are very old. And so a lot of the advisors are retiring with no real plan in place. You want to ask them if they can coordinate with other people that you find valuable in your financial planning journey. Those are great questions to ask. There could be others. Just want to give you an idea. Do your homework. This is a great website called Broker Check. Anybody can go to it. You can type in anybody's name. You can see what disciplinary actions have been done um, for them. This is, again, I want to kind of get the nitty gritty here. Basically, you have to either have your CFP or pass the Series 65 or 66 in order to act in a fiduciary capacity. So if you see these numbers, this person is not a fiduciary. So the only, again, exception would be if they are a CFP and then they are working with you under the capacity of a CFP. But I just want to give you an idea because the more you can be educated, the better decisions you can make when you're working with people. This is the Investment Advisor public disclosure website. And this is great because when you're looking for fiduciary firms or people, you can kind of see what their business background is. It's just a great website to look up the people that you potentially could be working with. CFP board's a great option. If you know the person's a CFP, you can kind of look up their name and see where they've been and if there's been any sanctions or disciplinary actions against them. And then how do they get paid? So these are kind of, this is a moving target basically, but I want you to understand what industry standards are. So these are industry standards anywhere from 75 to 125 basis points on assets that are managed. Now that could go down to 50 basis points if it's a really large account. And typically if you manage less money, so if you have a smaller account to invest, you're going to get charged a higher percentage, closer to that 1.25 range. Also, you can also pay for financial planning services. So that's based off usually what your household income is. That's how we operate at Brightworks. And so hourly charges can be, starting range somewhere in the 150 to 250. These can go up from there. Just wanted to give you a ballpark. But just so you have an idea. So if you meet with someone. When's the ideal time to engage? That is an interesting question, and it depends on where you're at. Everybody's answer is different. If you're seeing this video, you like what you heard, you want to engage more, feel free, reach out to me. You can send me an email, subscribe to this page. That's a great way to engage and learn more and see if this is something that might be right for you. We also have an Instagram page, but I did this because this is the presentation that I wish I would have had. I hope it was helpful and look forward to more educational content to put out for you guys and hearing from you soon. Please comment if you thought this was helpful, and yeah, we'll talk with you soon.